Hi there, it's Friday the 7th of December 2018. I'm Steve Towers. Welcome to ITB. And if you're wondering about this, well, I forgot to duck. Let's get started. Well, as expected, the EU's digital services tax was not approved by ECOFIN at its meeting on the 4th of December. The meeting considered two substantive proposals. The first was the latest compromise text prepared by Austria in the EU presidency role. Under this compromise text, the DST would apply from the 1st of January 2022. It would apply to businesses with worldwide annual revenue exceeding 750 million euros and EU annual revenue from taxable digital services exceeding 50 million euros. The rate would be 3%. There would be three types of taxable digital services: advertising, activities of marketplaces, and sale of user data. Regulated financial service entities would be excluded, and there would be a sunset clause and a review clause, which would require the DST to stop if and when a global solution is reached. But the summary of the meeting says this: following a thorough analysis of all technical issues, the presidency put forward a compromise text containing the elements that have the most support from member states. However, at this stage, a number of delegations cannot accept the text for political reasons as a matter of principle, while a few others are not satisfied yet with some specific points in the text. That text did not gain the necessary support and was not discussed in detail. The second substantive topic was a joint proposal by France and Germany, which has these elements: 3% DST, but limited to advertising revenue, effective the 1st of January 2021. To be agreed by ECOFIN without delay and in any case before March 2019 at the latest. And, separate from DST, the European Commission and ECOFIN to consider proposals in regard to a global minimum tax. The summary of the meeting says this: Ministers examined a joint declaration by the French and German delegations. The presidency recommended that the Council Working Group continues working on the basis of the latest presidency compromise text and the elements proposed by France and Germany, with the aim of reaching an agreement as soon as possible, which doesn't leave you with a lot of confidence that a unanimous agreement will be reached. For a copy of the compromise text and the France-Germany joint proposal, please go to our website. And by the way, the ITB app is currently being updated. It'll be back bigger and better in early January. The other big digital taxation meeting this week was a meeting of the Task Force on the Digital Economy to consider the three ideas or solutions identified by the OECD. Digital taxation based on user participation, which is supported by the UK. A broad-based expansion of market countries' tax rights, which seems to be supported by the US. And a global minimum tax, which is supported by France and Germany. In regard to the second of these, the broad-based expansion of market countries' tax rights, US officials have indicated that they envisage that the profit attributable to marketing intangibles should be allocated to the market country, even if the investments in those marketing intangibles are made and managed outside the market country. Last weekend's G20 leaders meeting in Argentina didn't produce any significant tax news, other than on the sidelines in regard to the China-US trade war. More about that in a moment. The leaders' declaration includes the usual paragraph on international tax. For a copy of that declaration and the report issued by the OECD, please go to our website. In Australia, the High Court has decided a stamp duty case which considers the meaning of goodwill. The case concerns a mining company. The court held that the meaning of goodwill in the context of the relevant legislation was the established legal meaning, attraction of custom. It rejected the added value concept of goodwill and the going concern value. The court also held that the appropriate way to value the mining company's land was the so-called top-down residual methodology. Start with the value of the total property, then subtract the value of assets which are not land, which produces a residual value which is attributed to land. For a copy of this case, please go to our website. Also in Australia, the tax authorities have released for public consultation a discussion paper on certain earn-out arrangements. Public comments are requested by the 1st of February 2019. For a copy of the paper, please go to our website. During the G20 leaders meeting in Argentina, Presidents Xi and Trump agreed a so-called 90 days truce in the China-US trade war. The immediate action on the US side is to suspend the scheduled 1st of January 2019 tariff rate increase on $200 billion of imports from China. Those imports currently are subject to a 10% tariff rate, but the rate was scheduled to be increased to 25% on the 1st of January. According to a US government statement, China agreed to purchase a not yet agreed upon but very substantial amount of US agricultural and other products. To say that the current situation is fluid is an understatement. And the Canadian arrest last weekend at the request of the US of a senior executive with Huawei adds to the intrigue. In Hong Kong, the government has decided to extend the profits tax exemption for funds to onshore privately offered funds in order to avoid being listed as a non-cooperative jurisdiction by the EU. The relevant bill is scheduled to be introduced into the Legislative Council today. For a copy of the Legislative Council briefing note, which includes a copy of the bill, please go to our website. In Indonesia, the government has issued a new regulation in regard to the claiming of treaty benefits. The new regulation, number 25 of 2018, will be effective from the 1st of January 2019 and will replace the existing regulation, number 10 of 2017. The new regulation simplifies and updates the administrative form which taxpayers must complete. In place of the existing DGT1 and DGT2 forms, there will be a single DGT form. For a copy of the new regulation, please go to our website. In Malaysia, the government has released proposed legislation which would implement some of the measures which were announced in the 2019 budget, plus some additional measures. Let me go through the highlights. In regard to the measures which were announced in the 2019 budget, the proposed legislation includes these: the reduction in the income tax rate for small and medium enterprises, the tightening of the group relief rules for the transfer of losses, the limitation on the carry forward of losses and undeducted depreciation, and the imposition of 6% service tax on imported taxable services, effective from the 1st of January 2019 for B2B transactions and from the 1st of January 2020 for B2C transactions. There are 3 additional measures which are worth noting. Firstly, some of Malaysia's tax incentive programs will be amended to make them compliant with BEPS Action 5. In particular, some tax incentives which apply to the insurance sector and the pioneer status for contract R&D companies. Secondly, there will be a new nexus rule for non-residents. Income derived by a non-resident will be deemed to have a Malaysian source if the income is attributable to a place of business in Malaysia. The proposed legislation includes a definition of place of business which is similar to the definition of PE in the UN Model Treaty, but without the exceptions for preparatory or auxiliary activities or for independent agents. As you can imagine, that's quite a wide definition. Commentators have said that this proposed domestic law definition should have no impact on the definition of PE in Malaysia's treaties. And thirdly, the existing withholding tax on outbound service fee payments. The proposed legislation includes a clarification that the withholding tax applies to both technical and non-technical assistance or services. And in New Zealand, the government has introduced into Parliament a bill to implement the proposed GST changes in regard to low-value imported goods. You'll remember that I covered those changes in ITB on the 26th of October. For a copy of the bill, please go to our website. In Belarus, the government has released proposed legislation which would make amendments to the transfer pricing rules. Significantly, the new rules would repeal the existing safe harbour which allows a 20% deviation from the arm's length range. For a copy of the new rules, please go to our website. In Croatia, the rate for the real estate transfer tax has been reduced from 4% to 3%, effective the 1st of January 2019. In France, the recent Yellow Vest demonstrations in the streets of Paris and elsewhere have caused the government to back down. The proposed increase in fuel tax, which triggered the demonstrations, has been suspended for 6 months, and it might even be abandoned if the government can find other revenue alternatives, such as a reinstatement of the wealth tax, which was abolished in 2017. And just to rub salt into the French wounds, the OECD this week released its Revenue Statistics 2018 report, which shows that France in 2017 was the highest tax country in the OECD. For a copy of the OECD report, please go to our website. In Serbia, the government has introduced into Parliament a bill which would make some interesting tax law changes. 3 items caught my eye. Firstly, the introduction of an innovation box regime, which would exempt 80% of the income from qualifying copyrights, patents, and related IP rights, but not including marketing intangibles. Secondly, a 200% deduction for R&D performed in Serbia. And thirdly, the removal of the current cap on the deduction of advertising and marketing expenditure. The cap is currently 10% of total revenue. And in Switzerland, the changes in the VAT law in regard to imports of low-value goods are scheduled to commence on the 1st of January 2019. And that has prompted Amazon to make this announcement. From the 26th of December 2018, customers shopping on Amazon.com, the Amazon US website, or other non-EU Amazon websites will not be able to ship non-digital orders to any shipping address in the Swiss Customs Union. It added that customers wishing to send orders to Switzerland should instead use Amazon websites in the EU. The reason for this new policy is stated to be changes to Swiss value-added tax law. This situation will be familiar to Australian customers of Amazon, which made a similar announcement but without the fallback to the EU shortly before Australia changed its GST rules in regard to imports of low-value goods. In Mauritius, the tax authorities have issued guidance in regard to the place of effective management, POEM, which is relevant to the tax residence of companies under the Mauritius income tax law. But first, some background. Section 73(1) of the Mauritius Income Tax Act defines a resident company in this way. For the purposes of this Act, resident, when applied to be a company, means a company which 1. Is incorporated in Mauritius, or 2. Has its central management and control in Mauritius. That's been the definition for many years. However, a new Section 73A has been inserted, effective the 1st of October 2018. Section 73A(1) says this: notwithstanding Section 73, a company which is incorporated in Mauritius shall be treated as non-resident if its place of effective management is situated outside Mauritius. So if you put those two provisions together, you can conclude that a company will be resident in Mauritius in two situations. Firstly, its central management and control is in Mauritius, regardless of where it is incorporated. Or secondly, it is incorporated in Mauritius, but only if its POEM is not situated outside Mauritius. Which of course raises the familiar question: what's the difference between central management and control and POEM? The tax authority's guidance is in regard to the location of a company's POEM for the purposes of Section 73A(1). The guidance is very short. Its key passage is this: generally, a company shall be deemed to have its place of effective management in Mauritius if A. The strategic decisions relating to the company's core income-generating activities are taken in or from Mauritius, and B. Any one of the following conditions is met. 1. The majority of the Board of Directors meetings are held in Mauritius, or 2. The executive management of the company is regularly exercised in Mauritius. You will notice that both A and B must be satisfied, and that B has two alternatives. In regard to A, it does not say that the core income generating activities must be located in Mauritius, only that the strategic decisions relating to those activities are taken in or from Mauritius. And by the way, I understand what it means when it says the strategic decisions are taken in Mauritius, but what does taken from Mauritius mean? For a copy of this guidance, please go to our website. In South Africa, the Supreme Court of Appeal has decided a case in regard to the simulation doctrine and the general anti-avoidance rule. The case concerns the purchase by a South African group of crude oil from unrelated suppliers in the Middle East. Under the purchase structure which was implemented, a subsidiary in the Isle of Man derived profits which were not attributed to the parent company under South Africa's CFC rules. The tax authorities asserted that a CFC liability did exist pursuant to the simulation doctrine and/or the GAR rule. If you look on the left, here are the transactions as documented by the parties. The Middle East suppliers sold the crude oil to Sisal, an Isle of Man company within the group. Sisal in turn sold the crude oil to Soil, a UK company within the group. And Soil in turn sold the crude oil to Sopel, a South African company in the group. The tax authorities asserted that Soil, the UK company, was included in this chain of transactions in order to avoid a tax liability under the South African CFC rules. If Soil were not included and Sisal sold the crude oil directly to Sopel, this alternative structure is shown on the right, the profit derived by Sisal would be attributed under the CFC rules. However, there would be no such attribution if Sisal sold the crude oil to Soil. I might say that despite some comments by the taxpayer to the contrary, it seems quite clear to me that Soil was indeed included in the chain of transactions in order to avoid that CFC tax liability. But nevertheless, the tax authorities lost the case. I'll focus on simulation. The simulation doctrine is the South African counterpart to the sham doctrine, which is recognised in a number of Commonwealth countries. You'll remember that I took you through the Canadian application of the sham doctrine in the Cameco case, which I covered in ITB on the 5th of October. The simulation doctrine, in regard to contractual documents, is focused on whether the documents genuinely reflect the intention of the parties, or alternatively are a disguise or deception. The documents can be held to be genuine even though they implement a tax avoidance arrangement. In this case, a majority of the judges decided that the contractual documents were genuine and that the simulation doctrine did not apply to the chain of transactions which included Soil. One of the judges in the majority, Judge of Appeal Ponnen, summed up the situation in this way. For the written agreements to have been a sham would have required the most extensive and elaborate fraud, stretching over a period of many years. It would have required the involvement of the persons participating directly, as well as the boards of directors of not just Sopel, but also their related companies. The conduct of the parties and the documents generated before, at the time of, and subsequent to the conclusion of the agreements belies that. There is not the slightest hint or suggestion in the wide array of documents introduced into evidence, such as letters of credit, bills of lading, invoices, and certificates of quantity and quality that the transactions were a sham or disguise. What is more, the financial statements of the relevant companies were entirely consonant with the supply agreements. The conclusion that such a sham was intended would mean that the production of these documents would have involved an elaborate fraud on the part of the authors of the documents and the members of the boards of directors of the relevant companies, as also their auditors, which indicates how difficult it is for the tax authorities in many situations to win on the simulation or sham argument. For a copy of this case, please go to our website. Also in South Africa, the tax authorities have issued updated guidance in regard to headquarter companies located in South Africa. For a copy of this guidance, please go to our website. Bahrain will be the next GCC country to implement VAT. It will do so in 3 stages. The first stage will be on the 1st of January 2019. From that date, Bahraini companies with an annual turnover exceeding 5 million Bahraini dinars, which is about 13.25 million US dollars, must comply with the VAT rules. Yes, that's a very high threshold. The deadline for registration for such companies is the 20th of December 2018. But there's no threshold for non-residents. Effective the 1st of January 2019, non-residents must be registered and comply with the VAT rules from the very first transaction. Voluntary registration for Bahraini companies with annual turnover below 5 million Bahraini dinars but above 18,750 Bahraini dinars will also be available from the 1st of January 2019. The second stage will be on the 1st of July 2019. From that date, the VAT compliance threshold for Bahraini companies will be an annual turnover of 500,000 Bahraini dinars, which is about 1.3 million US dollars. The deadline for VAT registration for this second stage is the 20th of June 2019. And the third stage will be on the 1st of January 2020. From that date, the VAT compliance threshold for Bahraini companies will be an annual turnover of 37,500 Bahraini dinars, which is about 100,000 US dollars. The deadline for registration for this third stage is the 20th of December 2019. Regulations implementing the new VAT system have not yet been released, which is unfortunate. However, the government has started a series of briefing sessions. One item which has been clarified is that invoices will not need to be issued in Arabic. The USMCA, the US-Mexico-Canada Free Trade Agreement, which will replace NAFTA, was signed by the leaders of the 3 countries last Friday as expected. It was one of the last official acts by the Mexican president. You'll remember that I covered the USMCA in ITB on the 5th of October. The new agreement requires ratification by the 3 countries before it will enter into force. That might be tricky for the US. When the agreement comes before the US Congress in 2019, the Democrats will control the House of Representatives. However, some commentators have suggested that President Trump might terminate NAFTA in order to put pressure on the Democrats. In Argentina, the government has reinstated tax incentives for oil and gas activities in Tierra del Fuego, the country's southernmost province. Previous tax incentives were removed in 2012. The new tax incentives will apply only to new projects and will be effective from the 1st of January 2019. Further information will be released by the government. In Barbados, the government has announced a major restructuring of its tax incentives in order to comply with BEPS Action 5 in regard to preferential tax regimes. Under current law, the income tax rate for regular business companies is 30%. However, significantly lower rates apply to companies which are ring-fenced within the international business sector. Well, all that will now change. Apart from grandfathering and insurance, there will be a standard income tax rate structure for all companies. The rates will be very low and they will apply on a reducing sliding scale. The higher the income, the lower the rate, from 5.5% to 1%. As noted by the Prime Minister in his statement to Parliament, Barbados will be one of the first countries to converge its local and international tax rates. The real question is whether we do so by converging our tax rates up to the local level and risk losing our international business sector and its tax revenues, or by converging our tax rates down to the international level and losing domestic tax revenues. We opt for converging our tax rates down to those that are internationally competitive. So instead of maintaining its preferential tax regimes and building in conditions to comply with the substantial activity requirement in BEPS Action 5, Barbados has decided to take the other path, remove the preferential tax regimes, in other words, treat all companies in the same way, and ignore any substantial activity requirement. Which makes me wonder about the Inclusive Frameworks plan to impose the substantial activity requirement on no or only nominal tax jurisdictions. I discussed this plan in ITB on the 23rd of November. That plan does not contain a bright line definition of a nominal tax jurisdiction. Will the new Barbados income tax rate structure qualify it as a nominal tax jurisdiction? If so, then things could get heated. This is what the Prime Minister said about BEPS Action 5 and preferential tax regimes. This pressure from the OECD may be hypocritical, it may be bullying, it may be an affront to natural justice as countries set rules for others that they do not adhere to themselves. For a copy of the Prime Minister's statement, please go to our website. In Colombia, the government has proposed to reduce the withholding tax levied on non-resident holders of government bonds from 14% to 5%. This change has been added to the tax reform bill, which is currently before Congress. And now for this week's treaty developments. We've had 6 treaties signed, 2 treaties enter into force, and another MLI synthesized text published. Well, that's the way it is this Friday, the 7th of December 2018. I'm Steve Towers. Have a great weekend.